I hope you enjoy watching this video. This is Chapter 22 for Accounting 202, Performance, Measurement, and Responsibility Accounting. I will be reviewing the highlighted learning objectives. First, we will look at preparing a responsibility report. A manager's performance using responsibility accounting reports should be evaluated using cost that a manager can control. A cost is controllable if a manager has the power to determine or significantly affect the amount incurred. An uncontrollable cost is not within the manager's influence or control. For example, the department manager would rarely control their own salaries, but they can control or influence items such as the cost of supplies used in their department. Next, we'll look at the differences between direct and indirect expenses. Departmental income statements are a common way to report profit center performance. We look at two key accounting challenges that involve allocating expenses. One, how do we allocate indirect expenses such as rent and utilities, which benefit several departments? And two, how do we allocate service department expenses such as payroll or purchasing that perform services which benefit several departments? The general model for cost allocation is allocated cost equals the total cost to allocate times the percentage of the allocation base used. And we'll look at several examples. Direct expenses can be readily traced to one department, and they are incurred for the sole benefit of that one department. So an example of a direct expense would be the salary of an employee who works in only one department. An indirect expense, though, cannot be easily traced to one department because they are incurred to benefit multiple departments. So if you have a building and that, for example, if you have a building that houses multiple departments, all the departments will benefit from rent, heat, and light. And since we cannot trace indirect expenses to individual departments, we must allocate them on the basis of the relative benefits each department received. We will look at allocating indirect expenses next. So here we're looking at an example of where an outside company cleans a retail store for a total cost of $800 a month. Management allocates this cost across the store's three departments based on the square footage in each department. The total cost to allocate is $800. The jewelry department occupies 60%, or 2,400 square feet divided by the total of 4,000 square feet. So it's allocated 60% of $800, which comes to $480. And you do this for the remaining two departments. When you're finished, you want to make sure that the total cost you've allocated is $800 for this example. We will look at a departmental income statement next. We must determine the expenses for each department using 3 steps. First, we will accumulate revenues and direct expenses by department. Next, we will allocate the indirect expenses across service and operating departments. And then we will allocate the service department's expenses to the operating departments. And lastly, we can prepare the departmental income statement. So we're going to show an example using A1 hardware, which has 5 departments. 2 are service departments, general office and purchasing, and 3 are operating departments. And those are the hardware, housewares, and appliances. So in step 1, we're going to show the direct and indirect expenses by department. In step 1, we will show the direct and indirect expenses by department. The total amount entered in the expense account balance column is equal to the individual amounts that are located under each department, service and operating. So the total expenses that we will allocate will come to $220,000, and you can see the direct expenses are cost of goods sold, salaries, depreciation on the equipment and supplies. The indirect expenses that we will allocate are rent, utilities, advertising, and insurance. So in the second step, we are going to allocate indirect costs. We show this with the departmental expense allocation spreadsheet that you can see. After selecting the allocation basis, we will allocate the indirect expenses to both operating and service departments. So the rent expense is allocated based on the amount and value of the space. Utilities expense is allocated based on floor space, square footage. Advertising expense is allocated based on the dollar of sales. So you can see that no amount is allocated for advertising expense to the service departments of general, office, and purchasing because they do not have any sales. And finally, the insurance expense is going to be allocated based on the value of the assets insured. The next step, in step 3, we allocate the service department expenses to the operating departments. So remember, the 2 service departments are general office and purchasing. And you can see that the total that needs to be allocated for general office is $15,300, and the amount that needs to be allocated for purchasing is $9,700. Notice also that at the end, we have 0 cost or expenses for general office and purchasing because those are allocated. We will look at the detailed calculations for allocating the indirect expenses in the appendix to this chapter. And then the last step is creating the departmental income statement, which shows the totals for each of the operating departments. So here we're looking just at the hardware, housewares, and appliance departments. And you can see the operating income or loss in the case of the appliance department. Departmental contribution to overhead looks at the direct expenses that are under the profit center manager's control. So this is a better way to assess their performance. This exhibit shows a $9,500 positive contribution from the appliances department. But if you look at the previous slide, the appliance department has a negative or an operating loss. But here we're looking at just the contribution to overhead amounts. So their revenue minus cost of goods sold, and then minus the direct expenses only. So if this department were eliminated, the company would be worse off because the appliance department actually contributes $9,500 to the indirect expenses. We will now look at analyzing investment centers using return on investment and residual income. Investment center managers are evaluated based on their ability to generate enough operating income to justify the investment in the assets used to generate their income. So some ways to measure this are return on investment, residual income, profit margin, and investment turnover. So an investment center's performance can be evaluated using what's called return on investment, or ROI, which is the operating income divided by the average invested assets. So we're looking at the information for ZTEL, a company that has two divisions, LCD and S-Phone. The LCD division makes LCD monitors and sells them, and the S-Phone division sells smartphones. In this exhibit, we can see the current year income and assets. Based on this information, we determined that the ROI for LCD is 21%, which is the investment center income divided by their average invested assets, and the ROI for S-Phone is 23%. So the LCD division actually earned more income, but it was less efficient in using its assets compared to S-Phone. So another way to evaluate the division performance is to compute the investment center residual income, which is the difference between their net income and the target income. The target income is the minimum rate of return on investment of their assets. So let's look at the information for LCD and S phones. The target income is 8%. So we're going to compute the target investment center net income for each and then subtract it from their net income and see which one has a higher residual income. So you can see the calculations in red at the bottom, and then we'll subtract that from their net income. So it looks like LCD division is doing better than S-Phone division using this measure. So now we will look at analyzing investment centers using profit margin and investment turnover. Profit margin measures the income earned per dollar of sales. It's computed as investment center income divided by their sales. The investment turnover measures how efficiently an investment center can generate sales from its invested assets, and it is calculated as the investment center sales divided by their average assets. The profit margin is expressed as a percentage, but the investment turnover is expressed in number of times the assets were converted into sales. So it's a number. Higher profit margin and higher investment turnover obviously mean better performance. So you can see that the profit margin for media networks is 29.36, and it's only 20.49 for parks and resorts. Their investment center for media networks is 0.72, and parks and resorts is only 0.64, and the return on investment is much higher for media networks at 21.14 versus 13.11%. This appendix will show you how to do the individual allocation calculations that we looked at previously for A1 hardware. We're using these allocation bases: floor space, dollar value of insured assets, sales dollars, and number of purchase orders. So these are the totals that we're looking at for each individual department. So the rent is going to be allocated based on space, but also on the value of the space. The two service departments, which are office and purchasing, occupy 25% of the total space, which is 3,000 square feet over the total of 12,000 square feet. But they're located in the back of the building, which is actually a lower value than the space near the front. So management will estimate that the space near the back accounts for $1,200 or 10% of the total rent of $12,000. So we're going to allocate the $1,200 between the two service departments based on square footage, which you can see in the upper graph. Then the remaining amount, which is $10,800 or $12,000 minus $1,200, will be allocated to the three operating departments based on their square footage. Utilities is allocated based on square footage. So you can see a total of 12,000 square feet, get the percent of the total, and then that percent of the total multiplied by 2,400. Advertising is allocated based on sales dollars. And remember, this is allocated only to the operating departments. So we add the three sales to get 239,000, get the percent of each, and multiply by 1,000. Insurance is allocated based on the value of the insured assets. So again, total up each one for each department, get the percent of that total, and then multiply by 2,500. The general office service department is allocated to the operating departments based on sales. And we did this calculation on the first spreadsheet we looked at. And then finally, the purchasing department is allocated to the operating departments based on the number of purchase orders they requested. This concludes the lecture on Chapter 22. I hope you learned a lot watching this video.